Let me ask you something. If someone gave you $10,000 today, what would you do with it? Most people would say save it. Put it in the bank. Keep it safe. And that sounds smart. But here's the truth. If you put $10,000 in a regular savings account today, in 10 years after inflation, you'd actually have less purchasing power than you started with. The bank pays you 0.01% interest. Inflation runs at 2 to 3% per year. You're losing money while thinking you're saving it. Investing is the only way to actually grow your money over time. And the beautiful thing, you don't need $10,000 to start. You don't need to be a finance expert. You don't need to watch the stock market every day. You just need to understand the basics. And that's exactly what this video is. By the end of this, you will know what investing actually is, how it works, where to start, and exactly what to do with your first dollar. Let's go. So what actually is investing? At its core, investing is putting your money to work so it grows without you doing anything. When you work a job, you trade time for money. You stop working, you stop earning. When you invest, your money works for you. Even while you sleep. Even while you're on vacation. Even when you're not thinking about it. Here's the simplest way to think about it. Imagine you have $1,000. You could spend it. It's gone. Or you could invest it. And that $1,000 starts generating returns. Year after year. Growing on top of itself. That's called compound interest. And it's the most powerful force in personal finance. Let me show you exactly how powerful. If you invest $1,000 today at an average 8% annual return, in 10 years you have $2,158. In 20 years, $4,661. In 30 years, $10,062. You put in $1,000. You end up with over $10,000. Without doing anything extra. Just by starting. Now imagine investing $200 every single month instead of just once. At 8% return over 30 years, you'd have over $300,000. From $200 per month. That's the power of investing consistently over time. And the earlier you start, the more time compound interest has to work its magic. Okay. So now you understand why investing matters. Let's talk about what you can actually invest in. There are 4 main types of investments every beginner should know. Number 1, stocks. When you buy a stock, you're buying a tiny piece of a company. If the company grows and becomes more valuable, your stock grows too. If it shrinks, your stock loses value. Stocks have historically returned around 8 to 10% per year on average. But they can be volatile. In a bad year, stocks can drop 20, 30, even 50%. In a great year, they can jump just as much. The key word is average. Over long periods of time, stocks have always gone up. But in the short term, they go up and down constantly. Number 3, index funds. This is where it gets exciting for beginners. An index fund is a collection of hundreds or thousands of stocks bundled together into one investment. Instead of buying one company's stock, you buy a tiny piece of hundreds of companies at once. If one company fails, it barely affects you. Because you own hundreds of others. The most famous example is the S&P 500 Index Fund. It tracks the 500 largest companies in the United States, Apple, Microsoft, Amazon, Google, all in one fund. Historically, the S&P 500 has returned around 10% per year on average. Over decades. Through crashes. Through recessions. Through wars. It always recovered and went higher. For most beginners, an S&P 500 index fund is the single best investment you can make. Simple. Diversified. Proven. Number 4, ETFs. An ETF is very similar to an index fund. It's a collection of assets that you can buy and sell like a stock. The difference is mostly technical. ETFs trade throughout the day while index funds are priced once per day. For beginners, ETFs and index funds are basically the same thing. Both are excellent choices. Okay. You understand what investing is. You know the main types. Now, how do you actually start? Step 1. Open a brokerage account. A brokerage is basically a platform that lets you buy and sell investments. Think of it like a bank but for investing. The best options for beginners right now are trading 212, eToro and Fidelity. All three are beginner-friendly, have no minimum deposit, and let you start with as little as $1. Opening an account takes about 10 minutes. You'll need to verify your identity, that's normal. Once it's open, you're ready to invest. Step 2, decide how much to invest. You don't need a lot to start. Seriously. $10, $25, $50 per month, it all counts. The most important thing is consistency. Investing $50 every month is infinitely better than waiting until you have $5,000 and investing once. Use the 50/30/20 rule we've talked about before. Take that 20% savings category, split it between your emergency fund and investing. Even if it's $30 per month into each, start there. Step 3, choose what to buy. As a beginner, keep it simple. Do not try to pick individual stocks. Do not try to time the market. Do not try to find the next big thing. Just buy an S&P 500 index fund or ETF. On Trading 212, search for VOO or SPY. These are the two most popular S&P 500 ETFs in the world. Buy it. Set up a recurring monthly purchase. And leave it alone. That's it. That's the whole strategy. And it outperforms 90% of professional investors over the long term. Step 4, automate everything. Just like your emergency fund, automate your investing. Set up a recurring transfer every payday. So the money moves before you even see it. Out of sight, out of mind. And growing every single month. Now let's talk about the mistakes that trip up most beginners. Because knowing what not to do is just as important as knowing what to do. Mistake 1, trying to time the market. This is when people wait for the perfect time to invest. They say the market is too high right now. I'll wait for it to drop. Here's the problem. Nobody can predict the market. Not Wall Street professionals. Not financial experts. Nobody. Studies consistently show that time in the market beats timing the market. Every single time. The best strategy is to invest consistently, regardless of what the market is doing. This strategy even has a name. It's called dollar cost averaging. You invest the same amount every month. When the market is high, you buy less shares. When the market is low, you buy more shares. Over time, it averages out to a great return. Mistake 2, panic selling. The market drops 20%. Your portfolio is down. You feel sick. You sell everything. This is the worst thing you can do. Because you lock in your losses. And then when the market recovers, and it always recovers, you've missed the rebound. Warren Buffett, the greatest investor of all time, has a famous saying. Be fearful when others are greedy. And greedy when others are fearful. When the market drops, that's a sale. Everything is cheaper. That's the time to buy more, not sell. Mistake 3, investing money you need soon. Investing is for money you won't need for at least 3 to 5 years. Ideally 10 or more. If you're investing money you might need next year and the market drops 30%, you'd be forced to sell at a loss. Always have your emergency fund fully built before you start investing heavily. Your emergency fund is your protection. Your investments are your growth. Mistake 4, chasing trends. Crypto. Meme stocks. The next hot thing on social media. These are not investments. These are gambles. Some people get lucky. Most people lose money. Stick to boring, proven index funds. Boring is beautiful when it comes to investing. The last thing I want to talk about is mindset. Because the technical stuff is actually the easy part. The hard part is staying consistent when things get scary. Here's the truth about investing. It will go down. Multiple times. In your investing lifetime, you will see your portfolio drop 20%, 30%, maybe even 50%. And every single time, it will feel like the world is ending. The news will be full of panic. People around you will be selling. Your job is to do nothing. Or even better, buy more. Because here's what history tells us. Every single market crash in history has been followed by a recovery. The 2008 financial crisis. The 2020 COVID crash. Every single one. The market recovered and went higher than before. The people who stayed invested and kept investing during the drops made enormous amounts of money. The people who panicked and sold locked in their losses and missed the recovery. Investing is not about being smart. It's about being patient. It's about trusting the process. It's about thinking in decades, not days. Start today. Be consistent. Don't panic. Think long term. That's the whole secret. There's nothing more complicated than that. Let's bring it all together. Investing is putting your money to work so it grows over time. The best investment for beginners is a simple S&P 500 index fund. Open a brokerage account. Start with whatever you can afford. Automate it. And leave it alone. Avoid trying to time the market. Avoid panic selling. Avoid chasing trends. Think in decades. Be patient. Let compound interest do the heavy lifting. Your future self will thank you. If this video helped you, subscribe. Every week I break down personal finance in a way that actually makes sense. And if you have any questions, drop them in the comments. I read every single one. See you in the next one.